Okay, welcome everyone to this other presentation of our Questrom Insight series. It's a great pleasure to introduce Michael Scanlon. He's the Managing Director and Portfolio Manager at Manulife Investment Management. He basically manages the John Hancock Balanced Fund, Manulife US Opportunities Fund, and large cap equity funds. Prior to Manulife, Michael was working at State Street Corporation as credit analyst, and he is a regular contributor to newspapers and magazines such as the Wall Street Journal, Barron's, the New York Times, and you can also see him regularly on CNBC and Bloomberg Television. So he's a CFA charter holder of the CFA Society in Boston, has an undergrad degree from Nichols College, and most importantly, MBA from Boston University. I quickly want to introduce myself. So I'm Marcel Rindisbacher. I'm a finance professor, but most recently the Senior Associate Dean for Faculty and Research here at Questrom. So in that role, I'm basically responsible for faculty hiring and promotion and other things like this. So welcome, Michael. It's a great pleasure to have you here. And I would like to structure this conversation such that you first introduce or give some kind of view on the stock market outlook and things like that. And then eventually we'll collect questions from all the participants here, and they can submit the questions through the chat function of the webinar here. And then I will basically refer the questions to you. So we are really like in very interesting times. So the stock market has just experienced a very strong record quarter. At the same time, unemployment is up to 15%, maybe in May, 13 to 16%. The Federal Reserve is engaging in all kinds of programs to basically pump money into the market. So how do you see where we are? What will happen? What is the outlook on the market? So I would appreciate if you could share some of your insights from your daily life as a portfolio manager of a really large fund. So.
Sure, happy to do that. And thanks everybody for taking the time to log in today. Yeah, certainly unique times. You know, if I think about where we were in February and the first half of March, obviously a much different environment after this big rally that we've seen quarter to date. I'll say quarter to date because the market hasn't closed yesterday, and who knows what's going to happen. It's still tick to tick out there. But you know, I think when you look at specifically the stock market today, this tremendous run up that we've had off the bottom, we clearly overshot to the downside, and now that we've had this rebound, in our view and how our portfolio is positioned today, it's largely our expectation that the market's probably stuck here for a little bit, with the next likely catalyst being more healthcare related than sort of fundamentals or valuations for the market. Thought process there being, we've already had some data on a few of the therapeutics, such as Gilead's Remdesivir, which they came out with the pricing of the product yesterday, so that was in the news. But you know, advancements there in terms of further therapeutics, and then in addition to that, and really the bigger driver is going to be the readouts that we get on these vaccines throughout the course of the summer and even into early September. You know, I think that those will largely be the big sentiment drivers. God willing, they're going to be good results and it'll be a positive for the market. And then the other thing I would keep a very close eye on, and obviously this has been at the forefront of everybody's mind the last couple of weeks, is just how these openings continue to progress. Obviously, there's a few markets out there, Florida, California, Arizona, and Texas, which have had some troubling data the last week or so. You're still not seeing the uptick in mortality ratios, but you certainly don't want the infections to flare up, and you don't want ICUs, you know, sort of busting at the seams in terms of capacity. So we'd like to see some improvement there. So I do think that right now the market's probably stuck until we get a little bit better of a readout on how some of these openings are going to actually go. And, you know, people are very focused right now as well on Q2 earnings, which are going to start in about 2 weeks. I would say in my mind and investors that I talk to that largely people are looking through to next year. It's very, very difficult to model a company right now in terms of what your expectations are for 2020. Just in fact that this is uncharted waters, right? This is unprecedented what we're going through, and trying to forecast consumer demand, industrial demand, advertising. I mean, you name it. It is just incredibly difficult in this environment. That being said, I mean, if you do look at our portfolio and how it's constructed today, there are a few trends out there that I think no matter how long this goes on for, I think that those kind of trends are uninterruptible, right? And those would be that advertising dollars are shifting online. So you think about names and they're coming off of TV, print media, newspapers, magazines, those kind of things. So if you think about names, there are obvious winners like Google, Facebook, even Amazon has a $15 billion run rate advertising business. I think those kind of trends are uninterruptible there. The other thing I would say is if you think about the trend of work from home or virtually learning, or just being home and you're streaming more or playing video games, whatever it is, I think you're seeing any of the data that's coming out of these broadband or mobile data companies, extraordinary growth year over year. And I think no matter how long this continues, I think you're going to see very strong trajectory there. And then the other big theme that's out there that's a very big presence in our portfolio, and this one's very obvious, is just more commerce going electronic. If you're trying to minimize your trips out to the store, as we all should be doing right now, you're seeing more and more dollars shift to electronic commerce and out of kind of traditional brick and mortar retail. And in addition to just more dollars, it's category expansion, right? So before, people used to buy books, electronics, those kind of things from e-commerce sites. And as now we've gone through this pandemic, people are expanding those categories. So now you have people buying toothpaste, deodorant, dog food, whatever it might be from e-commerce. And I do think that this big pull forward that you've seen in terms of the growth trajectory of e-commerce, I think it's very, very sustainable. And frankly, I expect it to pick up even more. And that's because when we do get back to normal, nobody's going to want to spend their time on Saturdays and Sundays going back to the store to buy those goods that they're now very comfortable buying electronically. So, those three trends, I would call them kind of obvious trends in the market. But, those are big positions for us in our portfolio today. And I think it also kind of folds into this broader theme that we have in our strategy. And the broader theme being that it's a Peter Lynch kind of market, right? Peter Lynch ran the Magellan Fund at Fidelity, just an unparalleled track record throughout his career before he retired. And his whole thesis was own what you know and watch what's going around with you right now. So, right now, if you're at home more than you have been in the past, and you're doing laundry and you're always putting Tide detergent in the washer machine, you should be looking at Procter & Gamble. If you're streaming more, working from home, learning from home, look at who your broadband provider is. If you find that you're buying everything from one or two stores now because you're trying to consolidate your trips out, or from an e-commerce perspective, look at those two stores. So I think that kind of an environment right now is very likely to continue to play out. And the other thing that I would say is, and I haven't seen this written about as much in the press lately, is that this has been the best stock picking environment that I have seen in my career since prior to the financial crisis. We had a 10-year run after the financial crisis where a very disproportionate amount of money that was coming into the equity markets was going directly into passive vehicles, right? So ETFs, index funds, those kind of things. And you had very limited differentiation in terms of performance of individual stocks, because every dollar that just goes into the SPY, it just buys the index in their standing weight. What you have seen this year through the market trough and even the recovery after has been differentiation in terms of performance at the individual stock level that, again, we haven't seen since probably 2007 or prior. Now, in full disclosure, that is completely in my favor, right? Completely in my self-interest. But I can tell you, as we look at the markets today, that's something that we're seeing. And our portfolio positioning really reflects that too, in that today we own far fewer stocks than we did 2 years ago, and our portfolio is far more top heavy. So our top 10 names are over 45% of the portfolio today. If we went back a couple of years ago, that number was barely over 30%. Today, we only own 59 stocks. You went back a couple of years ago, we owned over 70. So I do think that this is really a market where you should expect active management to mount a comeback and, really draw a line in the sand that some of this money that's flown into passive vehicles over the last couple of years has been, lazy money or whatever you want to call it. But I think thus far this year, you've actually seen pretty good performance from active managers. And so I think that's encouraging when you sit in the seat that I do. So I'll pause there. Hopefully that helps.
Okay, so thank you very much. One thing I wanted to talk maybe quickly about is that there are also unique measures in fiscal policy and monetary policy. So fiscal policy, you basically have like the forgiveness of small business loans or also the corporate bankruptcy program. And then on monetary policy, more important, when you think about consumer demand, you have like paycheck protection program that at the moment still seem to sort of like be in place, but a lot of this may go away. So to which extent in your portfolio strategies do you really factor in the kind of more political risk that is coming from maybe changes in fiscal and monetary policy, that some of these programs, they will not be there anymore, that the Fed changes course of actions and does not support corporate credit markets in the way they had. So there's little evidence that this is going to happen, but do you reflect actively on things like this, even in the context of a stock selection strategy, or are these sort of priorities of secondary importance?
Yeah, so if you think about the strategy that I run for John Hancock, it's a balanced fund that has the ability to go 75%, 25% in either direction, equities versus fixed income. So the more macro geopolitical factors, what central banks are doing, those kind of things, those influence that asset allocation decision on how we balance back and forth between equities and fixed income. But when we do the individual security selection on both the equity and the fixed income side, I would say that we view those ideas and those securities that we own as having the ability to stand on their own, and there's not a top-down call on those. So if we think about everything that's going on right now, and I'll sort of relay this to what I'm sure everybody's been reading or seeing on TV. You've seen a lot of what I would call industry thought leaders the last couple of weeks and even the last month or so, saying that they thought this was the most overvalued market they've ever seen, or those kind of things. One thing that you do in this business is you try to be right. You don't try to be philosophically right. You just got to be right. And so if the Fed is out there buying everything, right? Buying investment grade corporate bonds, buying high yields, doing everything but buying equities, cutting interest rates to zero, equities are going to go up. Right? That's just going to happen. That's what they're doing. That's their intention. So for a lot of these thought leaders that have been frustrated by this, they're playing more of the philosophical approach, and it just, that's not going to generate returns for you, because you're fighting an unwinnable battle when the Fed has all the power that they have to drive people into risk assets and equities. So, they're certainly concerned, right? I mean, you can't run a budget deficit forever. Some of these stimulus plans, which were absolutely the right thing to do and continue to absolutely be the right thing to do to get the consumer through to the other side of this. But at some point, yes, they're going to have to pull back on it. Now, you could take the boom, doom, and gloom view and say, well, as soon as they cancel the extra $600 per week of unemployment benefits, that the consumer activity is going to drop off a cliff. If you actually look at the unemployment report, it's something like 85% of the people that are unemployed are still furloughed or attached to their employer. So as we do get hopefully improving data and people can go back to work and are still largely attached to their employer, that's the opportunity for it to be replacing those enhanced jobless benefits that we're seeing right now. On the Fed side, again, I think they're doing the right thing. I mean, you had to induce confidence into the market and the economy. Obviously extreme measures. I think one of the most important things that the Fed's been able to avoid doing, which has been a mistake for every other economy in the world that has taken this step, is to go negative on rates. You have not seen any benefit in any geography over any period of time globally from any central bank doing that. I think it's very important going forward that they avoid doing that. And if you think about it longer term, yeah, the federal government's going to have a heck of a lot more debt going forward than they had 6 months ago. There's no denying that. And interest rates are going to be a lot lower for a lot longer period of time. So if you kind of take that information and you step back and digest it, you know, a really easy conclusion is if you have an unfunded liability, if you're a pension, an endowment, you're trying to fund your own retirement, saving for your children to go to college, those kind of things, you cannot meet those liabilities with the current level of global interest rates. You can't get there. So, you know, I do think that there's an argument to be made that equity valuations are going to be higher in the future relative to historical valuations, because frankly, somebody living in their 70s in retirement used to have, you know, a very small amount of their life savings in equities, and they would live off of fixed income yields. Going forward, that is going to have to change. They're going to have a higher equity allocation fixed going forward. So let's say hypothetically in the past, if the market was trading at kind of 18 times earnings, that would be a level that might give us pause. You know, we have to dial that up going forward, because now it's just, there's more demand for equities, which is going to drive up valuations going forward.
Mm-hmm. Well, how do you think about inflation in all of this? Is there a risk that there's too much cash out there and inflation may eventually pick up, and how would that affect your portfolio strategy?
Yeah, I think about inflation really in two ways, right? There's bad inflation because there's just all the printing presses that have gone on globally, and then there would be good inflation, which would be demand driven.
Exactly.
If we get to the other side of this and bounce right back and economic activity picks up and we go back to mid-single digit type unemployment and inflation picks up, we should be dancing in the streets. Because if you think about it, post the financial crisis, there hasn't been a geographic region globally that's been able to drive meaningful demand-driven inflation post the financial crisis. So if it's on the demand side and it picks up, again, we should be celebrating that. On the flip side of it, if it's a situation because of, you know, you get runaway inflation, like the terrible experience that something like the country of Venezuela has gone through the last couple of years, you know, obviously that's not good. I don't think right now inflation is really a big concern. You know, if we get a couple of more years down the road and we're still in this kind of an environment, then there'd be much more of a concern. But I don't think it's an issue that we need to really worry about for the foreseeable future. Frankly, capacity utilization is running low. You know, the U.S. actually has good longer term characteristics in terms of demographics, re-onshoring of supply chains, those kind of things. So I don't see inflation as a big risk right now. And frankly, I'm rooting for some demand-driven inflation.
Sure. I'm very well understood. Exactly. So the other topic I wanted to sort of touch upon is corporate debt. So after 2008 or so, there's this kind of evidence that really the markets were swamped with cheap corporate debt. And obviously that's something that is now at play as well in terms of the support in monetary policy to try to get people out of bad loans. The Atlantic had an article, I think this week, saying that there's a looming bank collapse. And sort of like history repeating itself from 2008. Now it's collateralized loan obligations or so that are at stake. And so do you really see parallels between the market in 2008-10 and what is happening now? Or what are the fundamental differences relative to deleveraging companies?
Yeah, so very short answer, no. When you look at the banking system today, in terms of capital levels, reserves, by any metric, the financial system is far more capitalized, far more stable. And, you know, it's an overused term, but if you think back to 2007 and 8, the financial sector was really the cause of the problem. And this time they can be part of the solution because they're in such a better position. You know, let's look at a very relevant example, right? Think about Goldman Sachs. In 2007, going into the financial crisis, Goldman Sachs had, they were levered 30 to 1. So they had $30 of assets to every $1 of equity. As of last quarter, it was 9 to 1. So with regulatory reform that's been put in place over the last 10 plus years, you can't get to the kind of leverage ratios that these companies had in the past. The other side of this is the corporate bond market. You can't just look at corporate debt balances in an absolute sense, because if you do that, obviously they don't look good. If you look at companies' ability to service those debts, or you look at it relative to interest coverage ratios or profits, or even debt to GDP, those kind of things, they're just not as stretched as you can make sort of the boom, doom, and gloom case about it for corporate debt. What I like, are we shying away from companies currently which have very high leverage ratios? Yes. Those stocks are likely to underperform in this kind of an environment. So that's kind of been a place that we haven't been adding to materially. But I don't see right now kind of this publicly traded company issue where you're going to see a lot of defaults. Now, people will point to the high yield market, right? You've had a lot of companies that have been downgraded, these fallen angels in the last couple of months here, and it's going to pick up. But a big characteristic there is, if you look at it, roughly 20% of the high yield market is in energy. So when you look at the performance of the high yield market, if you back out energy, it's not all that bad. Obviously, energy companies, big users of debt to finance asset purchases and infrastructure buildouts that they have to get those resources out of the ground and get them in a useful form. There's going to be a lot of downgrades. There's going to be a lot of defaults. There's going to be a lot of bankruptcies there, right? Chesapeake Energy yesterday filed for bankruptcy. There's going to be a lot of non-publicly traded companies in that space that go bankrupt. But overall, I think if you look at it, I mean, you still have a lot of these companies, even in the high yield space, that, yeah, right now their cash flows are impaired. But there is some recovery back towards normalization a bit. Right now, I don't see the stresses in those markets. And same thing for loan books at banks. Last quarter, you had banks take what I would call more material reserves against their loan books, whether it's consumer, CNI, whatever it might be. You'll see bigger reserves taken this quarter. But, to date, the companies are well reserved, and you haven't seen this big spike or material spike in terms of defaults. So a little bit of to be determined here and see how this goes going forward. But right now, things are going better than expected a couple months ago.
Yeah. Okay. So I think I've actually 100% agree with what you just said. I think these articles about the banks and so on, they are really not reflecting well on the kind of corrective measures that have been taken in order to fixing the banking system on this regard. Or so the issue may be now more on the corporate debt side, but again, I think the fact that you sort of, like, for example, shift your portfolio more top heavy is probably related to the perception of default risk. And so that's something that the market can deal with anyway in terms of changing the allocation of funds. So overall, sort of maybe, I have one question coming in from Mani Nakpal, who I think may be interesting in that context as well. So mentioned that we are in very uncertain markets and the NASDAQ has rallied to an all-time high of 10,000 plus. Is this justified? Is the market too optimistic? So it's the kind of shift that you described in terms of investing more into the tech sector and so on, but do you think people are getting crazy about thinking how really profitable the technology market will be, or is this really justified where the valuations of Amazon, Google, and so are at the moment?
Yeah, so obviously a lot of ink has been spilled talking about just how top heavy the S&P 500 has become, right? And the FANG trade, and it gets written about every day. I think when you look at those companies, this is any analogies trying to be drawn back to what we saw in 2000 in the tech bubble are, just not based on reality, and they're not based on fact. The fact that these companies are this big and it's justified in the valuations, and the valuations don't look stretched. I mean, if you look at something like Microsoft, right? Microsoft obviously had an extraordinary run the last handful of years. That's a company that's been around for 40 plus years, and they're still growing their top line in the teens and their net income at a greater rate than even that, because they got into this Azure business and growth took off, right? They made very good strategic decisions. Something like Google, another name in there, right? I mean, even last quarter, in light of the pandemic and people shutting off advertising as soon as they could, Google still grew their revenues 18% FX neutral year over year. So I think when you look at these companies, there's just such huge tailwinds for them, and they're so strategically well positioned. And I don't look at them from a stock perspective as saying their valuations are stretched. Now, I think, out of that FANG trade, the one that we don't own is Netflix. I think that one, frankly, I think the valuation's wacky on it, so we don't own it. Yeah. I don't know how they ever get to positive free cash flow. I don't think this push that they're making into emerging markets where they're getting roughly $1 a month per subscriber instead of 14 or 15 in developed markets ever gets them there, because they can't leverage the content, right? They have to continue to invest in content. So that's one where, I look at it and the valuation looks strange to me, so we don't own that name. But the other companies, they look very attractive to us. We own some of them, and some of them we own in pretty material size at the top of our portfolio. And the other thing is, don't forget, they operate in very different businesses too, right? Microsoft is an enterprise software company. Google is an advertising company. Apple is a hardware and services company. Netflix is a media company. And, you can go up and down the list. So it's not like they're all pure plays on enterprise IT spending or something like that. They do all operate in very different businesses as well.
I have a related question from Andy Baylor, who is also one in the audience here. So he had actually sort of interest also to learn about, do you really check on higher volumes of trade in the technology market, and how does volume information then affect the way you trade? Or is that irrelevant because you basically hold on the stocks for quite some time?
Yeah, so we're fundamental investors, and when we buy a stock, it's really built on a thesis of a 2-year investment horizon. So the day-to-day, tick-to-tick type performance of the name really isn't something that we focus on. If the question is more along the lines of what we've seen in the last couple of months here, and kind of a return of the big retail investor, right? Mm-hmm. Things like the Robinhood app has obviously been at the forefront of the news the last couple of weeks. That's something that we watch, but frankly, the stocks that have been highlighted by that big trend in terms of the return of the consumer or the retail investor to the equity markets, it's really been in stuff that we just don't typically play in. So if you think about something like Hertz, right? Auto rental company going into bankruptcy, is the equity going to be worth anything, or is the equity not going to be worth anything? We don't have an edge there. We move on to the next idea. So I haven't really seen an impact to our portfolio from the return of the retail investor. And for us, it's not about day-to-day flow. For us, it's a longer-term investment horizon. And I will say that with so much money going to kind of algo and quant traders over the last 5-10 years or so, I also think it's introduced a new opportunity, right? If you're not trying to call every stock tick to tick, and you can take a time arbitrage approach to it and say, well, I'm going to ignore this bandwidth of noise and just focus on, buying low and selling high over a 2-year investment period. I think there's this time arbitrage opportunity in stocks right now that's extraordinary. Now, you have to have the benefit of patient shareholders, right? If you run a fund and the shareholders can just pull all their money the next day, that makes it far more difficult. But I do think time arbitrage opportunities have increased pretty markedly as you've seen this explosion in the quant and the algo traders.
Okay, perfect. So maybe we can switch more specific information about the kind of portfolio management principles that you use in basically managing your funds. So you basically are engaged in 3 funds: the John Hancock Balanced Fund, the Manulife US Opportunities Fund, and the Large Cap Institutional Equity Strategy Fund. So for example, the Balanced Fund, what are the kind of principles that you're using when you make your investment decisions? So, or maybe describe first the fund quickly, what it is and what it tries to achieve.
Yeah, so I'll focus. The John Hancock Balanced Fund is the biggest strategy that I run. It's just under $3 billion of assets. It's a pretty flexible mandate. So we can go 75%, 25% either direction, equity versus fixed income. We can go 0 to 35% non-US. And then within the fixed income sleeve, we can go 0 to 25% high yield. So it's a pretty flexible mandate. And if we have a view on something, we have the ability to express it in the portfolio. if you look at any of our strategies and we manage the equities the same way across all of our strategies, really the guiding principle is that we're focused on total return, right? We don't just buy growth. We don't just buy value. We don't care how we get the return. It's just we want total return. And the bigger part of it is that every name in the portfolio has to stand on its own. So for a name to make its way into the portfolio, it has to have a margin of safety in the business. It has to have a margin of safety in the valuation. And there has to be a company-specific catalyst or catalysts. So margin of safety in the business, we're looking for companies that have dominant market shares, high barriers to entry, the ability to extract pricing power. So if you think about something like Amazon and their fulfillment network, right? At this point, it's going to be very difficult for anybody to catch up to the fulfillment network that Amazon has. Margin of safety in the valuation. You know, that can be a company trading below the replacement cost of their assets, a highly recurring free cash flow generative type business, some sort of hidden asset on their balance sheet that they could monetize. So if you think about something like, if you think about Apple, right, you have something like an 800 million user install base of iPhones that recur every 2 to 2.5 years, right? So it's very highly recurring and predictable cash flow business. And then catalysts, the catalyst can be anything. They just have to be company specific in nature. So in 2008, we wouldn't buy a bank saying that's the end of the financial crisis. Housing's going to get better. The economy is going to pick up. Let's buy banks because they're levered to the U.S. economy. It has to be company specific. So, an example there, in 2009, we established a big position in JP Morgan, really built on the thesis that they were in a much better competitive position going forward than they were prior to the financial crisis, because competitors are either gone away or were a shell of what they used to be. We thought they would be one of the first to start returning capital to shareholders, and their business mix from an ROE perspective had improved meaningfully. So again, those catalysts can be anything, right? If it's a tech company, it might be a new product or a new version of a product. Catalysts can be anything. They just have to be company specific in nature. From there, what we do is we model our companies and set 2 price targets, a downside target and then a 2-year type horizon upside target. Now, if nothing happens and that stock gets hit and drifts down to the downside target, it's quickly going to become one of the biggest positions in the portfolio, because at that point we have what I would call the ultimate risk reward skewed in our favor. Now, if things play out over a couple of years and the catalysts play out and that stock hits our price target on the upside, we have this prenuptial agreement with the stock telling us what are the catalysts, what's it worth, when to get out. And, that really forces the intellectual honesty for us to exit our positions. One of the mistakes that I've seen happen in our industry over the years is people just fall in love with their names in perpetuity and let valuations or thesis run away from them. I think that if you were to look back at our strategy, one of the things that I would focus on in terms of our success has really been a focus on that sticking to the margins of safety and the catalyst, and knowing when to get out and not just falling in love with the name in perpetuity.
Okay. So the decision basically stocks and bonds or so, do you really try to actively time the kind of markets and shift allocation from stocks into bond dependent on the environment you are in? And how successful is that going on in the fund?
Yeah, so
the difficult part, or is it the easy part of your overall strategy?
Yeah, so we try to generate alpha with that decision. We don't, some balanced funds sit on 60% equities, 40% fixed income in perpetuity. For us, that's an alpha machine for us. I would say it's still a strategic decision. So you're not going to go to bed tonight and we're 75-25 and wake up tomorrow we're 25-75.
Yeah.
It's a strategic decision in nature. It's also not sort of a blind quant model that we plug in expected returns and it spits out, well, you should be 70-30 or something like that. We think about it sort of blending art and science together. So the science would be, when we look at individual securities, where are we finding the best risk rewards? Is it in equity or fixed income? What are central banks doing? What kind of stimulus is out there? What's the market level of rates? What's the market PE levels? And so we take all those kind of various inputs and we bring them back. And then the science is kind of taking all that information that we have, analyzing it, and then, coming up with a weight profile in equities and fixed income that's within a risk framework that we're comfortable with. Now, as I talked about before, we have a lot of flexibility here, right? So one example would be we can go 0 to 25% high yield in the portfolio. High yield bonds are going to trade very highly correlated with equities. So if there's a period of time where we're finding a lot of value in high yield bonds, we're probably going to reduce the equity weight in the portfolio a little bit because we're eating up some of our risk budget by putting more money into high yield bonds because they're so attractively valued at that point. So for us, again, strategic decision, a lot of different inputs, but it's been a vehicle that we've been successful with in generating alpha. If I look at it, we exited for 2019, we were 65-ish% equities. We drew that down last year. We exited the year at 57% equities. We went into this crisis at 50% equities, and then we bought it back up. So year to date, we've actually done quite well with our asset allocation decision. And frankly, that's probably the most tactical we've ever been with it in terms of how we move things around. But, you get these opportunities and you have to take advantage of them.
For sure, for sure. You mentioned that basically the way you look at stocks such that they have to stand alone, but then at the same time, you still have to sort of like monitor the correlation between different stocks that you have. So do you have like a total risk budget that you use then to decide if one is becoming too big or too small in terms of the overall portfolio risk?
Yeah, so believe me, our head of equities is watching that on a daily basis. We have a risk management team that's completely independent from all the portfolio management teams. And we get a daily report on our portfolio that shows every risk metric that you could think of, and that I'm sure you're teaching in the curriculum. And so we're certainly on top of that. Correlations of individual names, we're definitely focused on that. Other metrics that we're looking at in the portfolio, right? And we've had a pretty low beta portfolio on my team year to date. That served us very, very well in the sell-off. And then on this recovery, we've had days when the market's been up 4 or 5% that we've lagged. We've had good stock picking, but overall our beta has been running a little bit lower than the market. So, that's something that's been at the forefront of our mind. It's an intended risk in the portfolio, right? There's unintended risks, and then there's intended risks that you have in a portfolio. That one's actually been intentional. But, the unintended risks that you look at, certainly, what are your names that are the biggest contributors to risk, and all those other various factors. We're monitoring that daily.
Perfect. So when you then sort of make the decision to buy a certain stock, you do a lot of fundamental analysis and so on. In terms of valuation models, do you use sort of standard academic valuation models, or have you used have you developed your own techniques how to do the actual valuation of a company based on a discount cash flow model or whatever you are using? Can you talk about this a bit?
Yeah, I would say one of the things I've learned in my career is that people invest very different ways, and I've seen people be phenomenally successful doing the polar opposite of what their competitor down the street is doing, is also phenomenally successful. So, there is no magic formula that's always going to be right and that works for everybody. So for us, when we're modeling our companies or doing a valuation perspective, what we try to do is we try to value our companies a couple different ways. We're not wedded to just DCF valuations or PE multiples. As we're working through a company, we might model it EV to EBITDA, earnings, free cash flow, DCF, and come up with price targets. And then part of the fundamental decision that we make is, from a valuation perspective, what kind of model fits best? What do we feel most comfortable with? So we reach our price targets any number of different ways. And I think that approach has kind of helped us too, because again, with this advent of the algo trader and how much they're driving, minute to minute and day to day performance of stocks, the fact that we have a portfolio of stocks that we derive those price targets on a number of different approaches means that, if PEs go out of favor with algo traders, or, momentum takes off or value falls off a cliff or whatever it might be, not all our stocks are based on that kind of a valuation metric. So I think for us, it's actually been helpful to look at it so many different ways.
Okay, perfect. I just have a related question coming in from Yoon Chin. So he basically asks about how do you think about P ratios up to 100 like Amazon? Is that of a concern? Is that out of whack? Or what do you think about the P ratios in general and then for specific high tech companies? So.
Yeah, I mean, there's no doubt if you look at some of these companies, they're pulling forward future cash flows or future earnings, right? So Amazon is a name that we have owned in size in our portfolio since, I think it was the third quarter of 2011. We own it at something like $160 in our portfolio. We've owned it in bigger size, smaller, but we've owned it that entire time. So it's been a huge winner. Mm-hmm. If you looked at Amazon, they have earned the right to invest because these investments that they've made, whether it's been increasing capacity in the fulfillment network, investing in the AWS business, whatever it might be, if you look at the return potential that they have on those, it's extraordinary. So, right now is something like Amazon under earning? Yeah, there's no doubt about it. I think it was last year, there was like $8 billion of expenses that they earned no return on, but you should expect at some point in the future, they're going to earn a phenomenal return on that. So if you took that $8 billion and just put it through to the pre-tax line, their profits would look a heck of a lot better. Now, for that company, we look at it on a DCF basis, and we still have material upside to our price target. So, yeah, if you look at it on current earnings multiple, it looks stretched. But when you look at the longer-term investment horizon and the assets that they have in place, we think there's really strong return profile there. Another name like Google, right? Google is, trading in a much closer to market, though still in excess of the market multiple, kind of in the low 20s when you look out. But you look at that company and yeah, their earnings right now are constrained by the fact that they're spending and investing, right? Could they be more judicious in terms of how they manage their expenses? Yes, last quarter they were, and they frankly told us that they're going to be for the rest of the year in light of this. But look at some of the investments that they've made in the past, right? They bought the Android operating system for something like $200 million. They bought YouTube for, I think, $1.3 billion 6 or 7 years ago. They've built out this cloud business. They own Waymo. When you look at these investments that they make, there's extraordinary value being created there. And, if you're just focused on what the current earnings multiple is, you might be missing something going forward.
Okay. Yeah, that's very helpful. I have a related question, which I'm not 100% sure if I understand. It's by Andrew, and he wanted to ask about the role of P ratios in 401k investments. So should you pay attention to this, or how could you actually, I think, deal with that? I don't know exactly what the question is, so maybe I have a freebie to basically take it from wherever you want to take it. So 401k investments and price earning ratios. So
yeah, I don't think that most individuals that have money in their 401ks that are outside of the financial markets or the financial services industry really focus on PE ratios. I think that's why so much gets written about these high dollar value stocks, right? Like your Amazons and your Googles and Berkshire Hathaway and those kind of stocks, is because people don't look at it relative to the earnings or the cash flow or those kind of things. So I think that more of the focus on that would be people just sort of blindly looking at what the absolute price of the stock is.
Yeah. Now, in general, so in retirement investment, there are a lot of kind of funds that have been created, like target date funds and other vehicles like this and so on. At the same time, are they really appropriate instruments in a market where active management seems to sort of come back very much? And so should you rethink about using vehicles like target date funds when you save for your retirement?
Yeah, I can't give specific advice to somebody on how to manage their retirement assets. But, if you think about those vehicles, most of them use active managers within there.
Yeah.
So let's say your targeted retirement date is, 2050. What that target date fund is going to do is start off with a higher allocation to equities. And then as you get closer to your retirement date, shift more towards fixed income. Within those portfolios, what they generally do is they are a fund of funds product, right? So they might have whatever the number is, 10 or 15 individual sleeves of portfolio managers. So you're getting a pretty diversified solution that's tailored to fit kind of what your risk tolerance would be as you approach that date, whether it's retirement or, within 529 plans and those kind of things. But you're still getting the value of active managers. Now, if you went with something like Vanguard's index funds, you would not get the contribution from active management.
Mm-hmm. Are you concerned overall about the state of a lot of pension funds, public or private? Or how do you think about this from an institutional investor perspective? These are important clients for institutional investors. Do you think there's some kind of really major risks looming out there of underfunded pension funds? And how do you deal with that?
Yeah, so I wouldn't say that impacts, on a day-to-day basis, how we think about things. Obviously, if you have an environment where, the federal government had to come in and start bailing out large states which have pension imbalances, that would factor into our decision. Yeah. There's obviously a lot being speculated right now that some of these states are forecasting way too aggressive return targets for their pension funds and those kind of things. If I had a solution for that, I'd probably be in some sort of elected office. I don't have a great solution for it, so I'm going to keep doing this.
Yeah. But you still think sort of what are the right kind of assets to do retirement savings? So funds are still the way to go, or should you think much more about individual stocks? Or it's basically you need access to professional management, like active management and other things like that. But you think there are big changes in the sort of overall menu of available assets for retirement saving on the horizon, or it's pretty much stable in terms of people using all kinds of mutual funds?
I would say you've seen a big shift, obviously, from active to passive in terms of investment options within 401ks and just utilization of people with financial advisors and those types of arrangements. Obviously, in the last couple of years, you've seen explosive growth in terms of ESG strategies, all right, and environmental, social, and governance. So those are starting to make their way more into 401k plans, and financial advisors are using them more as frankly, there's just demand for them. I don't know if there's going to be any changes in terms of what those offerings look like within kind of traditional vehicles. I would just expect that, there's going to continue to be fee pressure in the industry. Passive is, even if active management does start outperforming like it has year to date, I certainly don't think passive as a percentage of somebody's portfolio is going to go back to zero like it was, 25 years ago. It's going to have a place, and people are going to use it as kind of a fixed allocation. So I don't know if there's any new asset classes coming, as much as those trends that are kind of in place right now probably just continue and get bigger.
Perfect. You mentioned ESG, so Questrom has a social impact MBA that just redone some of its curriculum actually to talk much more about sustainable finance. And we have an initiative between the Sustainability Research Institute and Susilo Institute that tries to also basically provide some metrics to do really assessment of ESG investment tools and things like that. Is ESG playing any role in your strategy?
Yes, so we have an ESG team that's global, right? So we have members of the team sit in Boston, Toronto. I'm sorry, my internet service just cut out, but I think you can still hear me. Toronto, Hong Kong. So we have dedicated resources to that. From my team's perspective, yes, it's becoming very meaningful to what we do. We analyze every company from an ESG perspective as part of our fundamental research process before it's included in the portfolio. And then obviously there's ongoing due diligence in terms of any changes there. I think one thing that you do need to keep in mind, though, is that if there's an ESG risk within a name, but you feel like you're being compensated for it, right? So let's say your price target, absent the ESG risk, is $100, and now of this ESG risk, and you're dropping your price target to $75, but the stock is still only trading at 25. You're being compensated for that risk. So we are approaching it from that angle and doing a lot of engagements with companies, right? So if there is a diversity issue on the board, if there's an environmental issue, right? I could tell you countless companies that we've had these conversations with, like Walmart or Broadcom on the semiconductor side in terms of water waste and those kind of things. All that is a big part of it. And I would tell you, anybody on this call who thinks ESG is irrelevant, or if you think it's nonsense, or if you hear somebody in the press saying it's nonsense, that's fine, that's your opinion. But when you look at these stocks, the money is flowing to names which have advantageous ESG characteristics. So you need to be in the know on that, right? Cigarette companies, tobacco companies used to trade with a much higher PE multiple because it's addictive, right? You know that person's going to go to the store and buy another pack of cigarettes regardless of how much taxes go up on that pack of cigarettes or if the company increases prices. Tobacco stocks today trade at a lower PE ratio because anybody with any kind of ESG restrictions has to be cognizant of the fact that does not fall within a favorable rating of a company. So again, even if you're somebody like, there was a guy on CNBC a couple of weeks ago who was saying he thought ESG was nonsense. Mm-hmm. That's fine, that's his opinion. But when you look at the individual stocks are performing. The ESG names that are more favorable are going to see much more money flow. And at the end of the day, stocks are a supply-demand equation. If somebody is buying more of a stock, price goes up. If somebody's out there trying to sell more of a stock goes down. So you have to factor it in.
This requires sort of like measurement of ESG efforts of a company. Are you very confident in the kind of assessment of how much engagement there really is in ESG for a company, or is this a lot of like window dressing, marketing, PR, or do you really have substantive kind of evidence that they are really engaging in ESG topics?
Yeah, so we have, obviously this is only a couple years old for the industry, so there's still a lot of sort of feeling out in terms of what this is going to look like. I can tell you from our firm's perspective, we have an internal rating system, and every team is supposed to be at a certain level by the end of the next year, and then at the full level by the end of the following year, full adoption, and there's a bunch of metrics that you're measured on that. So for us, it's increased meaningfully. And, when I think when you look at other firms, could you point to an individual firm and say, well, they're just doing it from a PR perspective or window dressing? I'm sure you could do that. Yeah. But I can tell you for us, I mean, it's a part of everything we do. Every time we sit down with a client, a consultant, a gatekeeper at a big brokerage firm, that topic of conversation is a meaningful percentage of the meeting. So you better have your I's dotted and your T's crossed.
Okay, perfect. I think we are getting closer to the end. I have two topics I still would like to talk about quickly, about maybe international stock markets, and particularly emerging markets, and sort of where the dollar is. Are there opportunities in that market? And then I would like to switch later to basically talk a bit about how students entering the financial markets now, what should they watch out for? Give some advice from your own perception of your career or the current market situation. So maybe let's talk quickly first about emerging markets. Do you see any opportunities there, or are you actually diversifying internationally your risk, or the game is basically in the US and the dollar is such that it's much better to stay domestic?
Yeah, so if you looked at our strategy and you went back to prior to the financial crisis, we were very consistently running just about at our max, right? 35% non-US. Post the financial crisis, our international weight has been a low to mid single digit. Mm-hmm. And that's really been predicated on this view that the US is in a far better competitive position going forward than it was prior to the financial crisis. And you look at various factors there, right? The US actually has very good demographics, right? There's no other developed economy in the world that's adding 30 to 49-year-olds, which are your peak consumption years. Most emerging markets, frankly, aren't adding that demographic. A pretty dynamic economy, right? Think about the names that we talked about: Facebook, Amazon, Netflix, Google. Those are companies that are started in the US. And now you have this tailwind of a very likely re-onshoring of supply chains and manufacturing in light of COVID, And you certainly heard a lot of that on Q1 earnings calls. Taiwan Semiconductor, it was probably in the last month, announced they were going to spend $12 billion to build a semi-fab location. I think it's in Arizona, somewhere in the U.S. This is newer stuff. I think when you look at some of the other economies around the world, we haven't found value there because they're really on the opposite of those trades, right? Challenged demographics, negative interest rates, less dynamic of an economy, regulatory environments which have not been conducive to building up these new companies. And specific to emerging markets, in our portfolio today, we don't own a single standalone emerging market stock. I think that, the big issue there, and you touched on it, is the strength of the dollar, right? So emerging market companies and governments issue their debt US dollar denominated. So when the dollar is strong, that makes their debt that much more expensive to repay. And that's the kind of an environment that I would expect going forward. I don't see a compelling argument why the US doesn't maintain its position as the reserve currency going forward. If you need any kind of yield, really the only market that you can get any positive yield is in the United States. So that continues to draw money into our fixed income markets. So I think emerging markets, probably much more subdued growth going forward. Obviously, China's the biggest country, which falls into the emerging market bucket, even though it's the second largest GDP in the world. And obviously a lot of issues there. So right now, our primary bias has been to be domestic, and we only have a mid-single digit non-US exposure today.
Okay, so thank you so much. So let's talk a little bit about sort of like advice you would give undergraduate and MBA students thinking about a career in finance. So also given the current circumstances, what should they really watch out for? So what factors did you learn yourself that were really important in terms of making progress in your career?
Yeah, so for me, undergrad, as you touched on, I didn't go to BU undergrad. I went to business school there. So I came out of a very small Division III university that probably nobody on this call has even ever heard of. And so I knew that if I wanted to get into the financial services industry, and I knew I wanted to be a buy-side equity analyst or PM coming out of undergrad, which I don't know, probably sounds weird, but I knew that's what I wanted to do. I knew there was a path I had to take. So I did my MBA at BU in the evening program. I took the GMATs, I think, a month after I finished undergrad, and I started less than 6 months afterwards. I did the evening program year round for a couple of years. I knew that wasn't enough. I knew I had to get the CFA as well, CFA designation as well. So I jumped right into that. And then, I've also been very, very lucky with the people that I've been associated with professionally. The greatest mentors in your career are probably not going to be somebody that's part of a formal mentorship program. For me, it's always been, the people that have hired me, that have grown up under and stayed very connected to, and just proving yourself over time. I would say right now, it's obviously a very difficult job environment. I have no doubt in my mind that we're going to get to the other side of this, and we're going to get back to normal, and we're going to hug our friends and our grandparents and just get back to life as normal on the other side of this. I have no doubt in my mind. If I was a May graduate this year, what I would be focusing on is, if somebody asked me the question on the other side of this, how did you use, or what did you do during that time of quarantine? You want to have something tangible to point to. So if you're a recent grad, or this is your junior going into your senior year, I would spend time working on individual companies, right? Put together kind of an elevator pitch on individual equities, if that's what you want to get into, the equity market. And build up what a fundamental thesis is. Put a price target on something. Tell them what you think it's worth. And just be able to have those conversations rather than, I can tell you what I've seen in the past. Sometimes recent undergrads, what they'll do is they'll give you like a 75-page data download from a 10K and just say it's a good investment. Well, A, I don't have time to read 75 pages from a bunch of job applicants. And B, you might have a company where those great fundamentals and everything are already in the stock price, so it's not a great investment. So I think that's really important to do, and it differentiates you. And you know, the other thing is, if you're a recent grad, or I think actually in your senior year now, you can enroll in the CFA program. Just putting on your resume that you are a CFA level 1 candidate, and that shows the self-drive and your work ethic, because everybody in this industry knows how hard that exam is. Just do it. You know, they say the CFA exam is like passing the bar exam 3 times. That's why it's not going to lose value in the industry, and that's one of the ways you can more easily make your resume rise to the top.
Sounds really great, yeah. Okay, so we're getting close to the end. I have one final question from a student, and it's a very open question. So it's basically, what is your biggest concern over the next 2 years? Thinking about your job, so.
Yeah, biggest concern over the next 2 years would be, I mean, right now, obviously, it's COVID related. Yeah. I think some of the data that was seen to date in terms of these vaccines is very encouraging. I have no medical training whatsoever, but you know, the gentleman who covers healthcare on my team is extraordinary. His insights have been of incredible value, not only the portfolio, but you know, as somebody who has a wife and a couple kids. You know, obviously, that is front and foremost the biggest focus right now. I think a little bit further down the line, even though it's really only whatever 5 or 6 months, is the U.S. election cycle. Yeah. The market tends to like the known and not like the unknown. So if you're going to have an environment where, you know, the Democrats take the White House, the House and the Senate, and it's a dramatic shift, or, you know, if it goes all Republican in the other direction, you know, the unknown of what the legislative outlook would look like is probably not going to be well met with the market for the interim. And then in the important to that as well is just at some point, and now is not the right time to do it, downsizing the Fed's intermediation that they're having in the economy, right? I mean, we need to stop running trillion-dollar deficits in perpetuity, not have the Fed be as heavy-handed in the performance of the economy. And, you know, as we saw before, right, we had the taper tantrum when the Fed started to unwind a number of years ago. It would be nice to see a smooth exit this time.
Okay, I think that's fantastic. That almost closes the circle from where we started in terms of also what the role of the Fed is and so on. So I would like to thank you really very much to do this. These are great opportunities to connect with alumni. These are our assets that we produce here at the university, and I know how much credit it should do. Basically, performance attribution is quite often difficult. I know if people are successful because of Questrom or despite of Questrom. I hope it's because of Questrom. And also, but then at the same time, as you mentioned, I think it's also really important to combine the knowledge you get here in class with some kind of self-discipline and drive to really want to get there. And I think we have a couple of remarkable students here who participate in these events, and it's a great opportunity to basically, stay connected. And I hope this is not the last time that we have a conversation with you. This was really, really very insightful and helpful. And I'd like to thank you very much for doing this.
Well, I'm more than happy to do it. I've always enjoyed my time coming back and speaking to the investment club, and spoken to a few of the undergraduate classes as well. So it's, I'm happy to do it, and certainly, you know, very proud to be a BU alumni.
Thank you so much. So until the next Questrom Insight talk, I'd like to thank all the participants, and goodbye. Thank you.